We have done about 1,000 interviews on why it is so important to start saving for retirement early for all the reasons: compound interest, you've got your vested interest, all the reasons. And some people haven't started saving early for lots of reasons. They, didn't have the free cash flow. They didn't know they should. They were procrastinators, whatever it is, no judgment. Some people just didn't get started when they were 18. We're going to talk about a book today that addresses that very real circumstance for people. Its author is David Trahair, and the book is called The Procrastinator's Guide to Retirement, a financial guide to retiring in 10 years or less. David, hello.
Hi, Bruce.
You would maintain that this is possible, which I think is the most important thing listeners need to take away. Is you're not destined to a life selling pencils on the street. There are things you can do if your time horizon is shorter than if you started at 18. Why do you feel confident in that view?
I feel confident in that view because I've researched it, studied it, and lived it. I'm 66 years old right now, and I started researching and writing about personal finance about 30 years ago. So I've got a lot of feedback from people. I've written books, I've given courses on it, and actually lived it myself. And basically, the reason I wrote this book is to give people hope, because as you said in the introduction, life is expensive. I mean, many people just don't have thousands of dollars lying around at the end of the month to put into their retirement savings because they're paying the mortgage or raising kids or paying for their education. So I think a lot of people end up in a situation when there's 10 years or less to go to retirement and they're way short, or at least according to the traditional plan, they're way short. And the problem with that is that many people then just give up. They say,
Right.
look, I'm supposed to have millions of dollars. I should have started when I was 20. I didn't start till I was 40. I have nowhere near $1 million saved. It's hopeless. I give up. So this book really is to give people hope that there is a lot you can do. And as an accountant, I make that case because I crunch numbers. I
Mm.
show a sample family. The book comes with a spreadsheet called The Procrastinator's Guide to Retirement, where you can punch in all your own variables and then project and see where you're going to be at the end. So it's really to give people hope that there is a lot they can do.
There's a whole series of chapters in which you walk through the credibility points on why there actually is hope, because the numbers say there are. Chapter two
Mhm.
is about when expenses decline, and I think this is really helpful because a lot of people think I need to save all this money so that I can travel the world, and life is going to be very, very expensive. You would make the
Yeah.
case that for many retirees there is a portion of that chapter, maybe a long period of time, in which life doesn't actually cost that much.
That's correct. This all gets back to the traditional retirement plan says you'll need about 70% of your pre-retirement earnings to maintain your standard of living. That is a total guess that may be totally incorrect. Maybe you need more than that, maybe you need less. So basing your whole retirement strategy on a guess is not a logical way to do it. So what I tell people is, look, everybody's personal financial situations are as individual as their fingerprints. Everybody's different. So your fingerprint is your spending, not arbitrary percentage of your income, but your spending. So I highly encourage people to track their current spending. That will then give them a basis upon which to project what their spending is going to be in the future. So I say, look at every outflow you've got and think about the characteristics of all those outflows. Some items are going to automatically stop or decline as soon as you retire. CPP, EI premiums, taxes are going to go down, RRSP contributions or pension contributions. So there are a certain category of outflows for many people that will automatically decline at retirement. But the opportunity, I call it the golden opportunity, is those other outflows that have nothing to do with your retirement date. And often they are large outflows, like your mortgage, housing costs,
Hmm.
auto loan and lease costs, costs of raising your children. These costs have nothing to do with retirement. Your mortgage doesn't automatically get paid off on retirement. It gets paid off if you diligently earn more, spend less to pay it down sooner or later. Uh, so an analysis of your current spending is the best thing you could possibly do to sort of
Yeah.
project where your spending is going to be in the future.
One of the tough decisions that people face is, should I save in an RRSP, for example, or should I
Yeah.
plow down that mortgage because I don't want to be having a mortgage when I'm 75 years old? What
Yes.
does your analysis of the math say in terms of the choice that people would need to make with that, 500 or $1,000 a month, maybe that they can
Right.
move to surplus? Where is it best deployed?
Well, first of all, if it's RSP versus pay down the mortgage, either thing is a great thing. You cannot lose whether you do one or the other. So that therefore makes the decision not as vital. Essentially, RSPs work perfectly in the right environment, and that is a marginal tax rate environment of a high bracket when you're making the contribution, you're working, earning your big salary, and you're going to be earning less money when you take the money out during retirement. So that's generally the flow or the best case scenario. I maintain that an ideal situation is to aim for total debt freedom at retirement. So you try, and if you can afford a house, not everybody can afford a house, but if you have a house with a mortgage, aim for zero mortgage, zero debt at retirement. That will set you up really well going into retirement when your income's going to decline. Because if you've got a big honking mortgage, you are watching the Bank of Canada rate decisions and things like that because you're worried that interest rates are going to go up. That
Mm.
can really demolish your finances during retirement when you're on a fixed income. So by paying off the mortgage, you eliminate that risk. So then it becomes sort of a game between how well do you think you're going to do in your RSP versus what's the interest rate on your mortgage. Um, so in the 80s, back in the 1980s, when mortgage rates were double digits, paying off the mortgage was obviously the better option. The problem is most people don't know. They don't know how well their RSP is going to do in the future because the stock market is very unpredictable. With
Mm.
paying off debt, you've got a guaranteed after-tax rate of return of whatever that interest rate is on the debt. So you cannot lose by paying off that debt. Having said that, if you put all your marbles in paying off debt, get to retirement totally debt free, you own the house, and you've got zero saved, well, most people can't finance their retirement from CPP and OAS alone.
Yeah.
So you've got a problem then. Most people in that situation then take a home equity line of credit to pay the bills. So
One
it's it's
one of
it's a
the one of the assets that people have, if they're lucky, they have, is real estate. How do you
yeah,
help them think through what role that can play to enable them to retire and live a reasonable lifestyle? Because I think one of the areas where people really get stuck is, I want to age in place and live in my home forever, or I'm going to
mhm,
downsize, but I'm not going to unlock that much equity. So your
yes,
house doesn't end up being that helpful to you, even though
no.
on a piece of paper it's worth this outrageous amount.
That's correct. Yeah. I mean, using your house as a vehicle for saving retirement is not recommended. It's extremely dangerous to do that because what happens if the housing market's just done this right before you retire
Mm.
and you can't sell it for nearly as much as you thought you could? Um, so the housing decision is a very difficult one, especially for younger people now deciding whether to buy. And I think one of the risks is that people think about this asset growing on their net worth statement. Wow, I'm going to be rich at the end. They don't think about the cash flow implications of holding that house, and especially a larger house. If they stretch their budget, they got a huge mortgage, property taxes, maintenance, insurance, utilities, and that sucks a lot of cash out of their cash inflow and can really demolish their finances. So buying a house and using it as a retirement is a very dangerous strategy.
I want to get to Canada Pension Plan and maximizing Canada Pension Plan, because that's not something that people talk a lot about. They hear about the nest egg, they hear about RRSPs, but if you're
Right.
someone who's worked your whole career, you've paid into that, you're going to get something. How do you
Yes.
get the most of that something that's available to you?
To get the most Canada Pension Plan, essentially it starts the month you turn 18 and typically goes to the month you turn 65. That's 47 years. But there's a general dropout provision of 15% of those years. So really you only have to have maximized for 39 years to get the maximum CPP pension. Most people haven't done that. The average is only about 60% of the maximum for most people when they start collecting their Canada Pension Plan. But I'm a huge fan of the Canada Pension Plan. It's well funded. It's a government-backed defined benefit pension plan that's adjusted for inflation every year
Mm.
and paid for the rest of your life. So unfortunately, it's usually not enough to finance most people's retirement, but it
Yep.
is guaranteed money for the rest of your life. Can't beat
Where do
that.
you net out on the question of delaying it? So if you're a late
Yeah.
to the game here, are you going to try and like squeak by and hold to 70 so you get the maximum monthly payment?
It depends on how long you're going to live. So to answer the question, you have to tell me when you're going to die. So that's kind of a
When I'm
problem there.
95 and in my sleep, surrounded
Yeah,
by family and friends, there will
hopefully.
be Broadway musical show tunes playing when the moment occurs.
Exactly, yes. I mean, if the history of your family, like my dad just turned, or he's going to turn 97 in January. So hopefully I have a similar lifespan. If you are likely to have a longer lifespan, delaying till 70, getting the 8.4% premium for every year after age 65 to 70, a 42% higher amount per year starting at 70 is the way to go. It's adjusted for inflation. If you die young, you lose with a defined benefit pension plan. But the CPP is basically a guarantee against a long life. You're at least going to have that money coming in from the government.
What role do you think financial advice plays for those who, in your word, procrastinators trying to
Yeah.
get a handle on retirement when their time horizon's short?
A financial advisor is extremely important. It's really important to have a good financial advisor, depending on your situation. I mean, I give courses to other CPAs. A lot of CPAs now are starting to do it themselves with a discount brokerage account or a robo-advisor account that really cuts the fees down significantly.
Mm,
But the average Canadian, that's dangerous, right? It can be attractive to say, I want to reduce my fees, but if you don't really know what you're doing and you're not going to spend time on it, you could do more harm than good. The problem is there is no list out there saying here are the good advisors and here are the bad ones to avoid. There isn't that list out there. What I have been talking about for 20, 30 years since I wrote my first book is that a lot of the people in the financial industry are really salespeople in disguise. They
yeah.
work for a financial institution, they need to be selling products that make money for the financial institution. So a mutual fund is a typical example of that. With these high expenses, this management expense ratio of 2% out of your
Yeah.
rate of return, it's very difficult to see how you're going to get ahead with those kinds of fees. Having said that, there may be fee-only financial planners and other advisors that charge a fee of 2%, and they're worth it. You get a great return after that
Right.
2% fee. So there's a whole
There,
range out
there,
there.
there is hope, as you
There
say,
is hope.
David, and I believe it is true. Your book is a great resource for people who, are closer to the end of their career than to the beginning. David
Right.
Trahair, thank you for joining us today.
Thanks, Bruce.
David Trahair is the author of The Procrastinator's Guide to Retirement, a financial guide to retiring in 10 years or less.